High level, we are the Equilibrium team. We are the family office for everybody. We're going to introduce you a little bit to that later. It's a combination of me. I'm Jeremy. I have started a few technology companies, one called Spot Hero. You probably used it to park somewhere. And if you haven't, I don't care about you. There's Itai. Itai, give a little quick about yourself.
Yeah, in the past, I founded a wealth advisory firm, as well as a hedge fund, and I do most of the financial analysis here.
And if he's not the smartest guy here, then we gotta up the stakes, and we'll introduce you to our third partner, Tori, a little bit later. Okay, but we're gonna put on ice for a second. So, Itai, it's now your moment. I've done my schmoozing. I can now check out, go to the couch, and sleep like my parents. You want to handle this? You want to take it?
Let's do it.
Go for it.
So as you notice, the warning signs from Microsoft have disappeared.
What, you paid for it?
Here's the thing, I didn't. They just disappeared.
Wait,
you won the war of attrition?
No way.
I swear that's what happened. So
amazing. Congratulations. For those of you who don't know, Itai has refused to pay Microsoft for a subscription for like a year now, and it looks like they've just given up trying to collect.
That is correct. Don't fall for it.
All right, Itai, everybody here is waiting for good content. Okay, so you better deliver tonight. Okay.
All right, I'll do my best. So market overview. This will be the last call of the year. So if there's any questions about anything from before, feel free to ask as well. If you remember anything we talked about during the year, I'll dive right into it. So as Jeremy mentioned, we're Equilibrium, family office for everyone. And let's dive right into it. So IPO dash, I'm not going to talk about the Airbnb one unless there's specific questions about that, because I do feel they have somewhat of an interesting business, but DoorDash is something that I found to be pretty interesting. It took the global pandemic to get them to post 1 quarter of profits, and they did have somewhat of GAAP profitability. Only firms right now with the worst trailing 12 months of operating profits are Uber and Lyft. And even during this time, DoorDash was at a minus 12% margin in this environment. So I just found that to be kind of interesting and wanted to start with that. And at the same time, their S1 themselves says that they're anticipating increasing expenses. They may not be able to maintain profitability. So let's talk about the profit margins of these various different companies. You can see here Grubhub at -5, Dash at -12. And Yum Brands, they're phenomenally profitable at 24%, Domino's Pizza, etc. So why is this interesting for whoever may or may not have bought that IPO? Their market share is actually declining as Grubhub, Uber Eats have taken larger market share, but they still own about 50% of the entire business, the entire market for food delivery. So why is this pretty crazy? Their IPO valuation was about 29 billion, but as everybody know, they pretty much doubled during the first day as Robinhood investors flocked into the stock. And at that current valuation at IPO, it implies that they're going to be able to reach 69% of FedEx margins, and they will grow to 64% of the entire global food delivery, which are very, very, very lofty goals to achieve at that current valuation. So you got to ask yourself the question of how likely is that?
You're already losing market share to the other people, and that doesn't really bode well for them.
Right. So what's crazy is that they're currently charging restaurants 30%, and they're 50% of the US market share for food delivery. So you can see here how an average restaurant delivery ticket is 25 bucks, because when people dine in, they usually order beverage, which is another $5. So the restaurant literally makes half of what they normally do between the two when it's delivered out. So it's going to be very, very difficult to grow profitability when you're already charging restaurant 30% and pretty much hitting them kind of hard. And none of that really matters, right? Because you're in a specific market with a lot of liquidity and a lot of money is chasing deals. So you can have IPOs like that. At the same time, just for everybody to know, a very, very significant milestone occurred this past week, where I believe it was 2 weeks ago, where the global equity markets reached $100 trillion in total value. And that's something pretty notable. And early in the year, they were closer to 60 trillion in value. So that's an insane amount of value that was created since the pandemic. And something interesting to note is, when you're looking at aggregate market value, and this is based on things like EBITDA and net sales, and I won't go into the complex calculation of that. Every time the market has gone to the more or less the fundamentally intrinsic value of the market, it was a pretty good buying opportunity. And that also happened early this year.
So real quick, you're basically saying the red graph is the graph of the value of the debt, right?
No, so the red graph, just so there's no confusion, is the total stock market cap. Basically, you're taking the price of the stock and multiply it by the number of shares outstanding for the market cap.
Okay.
The blue one is when you do that and you add debt to it.
Okay, that makes sense. Got it. All right. So every time that this hits your green line, the aggregate market value, then that's usually signals a great buying opportunity.
Right, because then the market cap is valued exactly perfectly based on the fundamentals of the companies, which is kind of interesting to know.
Cool.
So there's no alternative really to investing right now, is the way it's seen. There are very, very little alternatives to investing. Why is that? Central banks, as we all know, and we hammered that point quite extensively, are keeping interest rates low as debt burdens are continuing to grow. So even the worst of companies, the high yield debt index, the yield right now has never been lower and is broken through prior lows in 2019 and 2014. And the total amount of negative yielding debt in the world is approaching all-time highs at about $17 trillion. Think about it for a second. There's $17 trillion worth of bonds with a negative interest rate. Crazy concept. So money really has to go into riskier and riskier assets in order to generate a return. And if you felt to yourself, well, maybe this market's overvalued, so I want to short it, as a lot of people did, and a lot of very, very smart hedge fund managers did. This year was actually the worst year on record for bears and for people with a short bias. So here to the right is the performance of the most shorted stocks in the world. So basically, companies like, you can think of Tesla or Moderna, which had very large percentage of their stock float, which is held short. This index from the beginning of the recovery has basically exploded to new highs and farly outdid the market itself. Wherein short bias funds have lost record amounts of money, over 30%. So the fact that you think something is overvalued or something crazy is happening in IPO markets is definitely not a recommendation to bet against it, because remember, the market can stay insolvent, or the market can stay irrational longer than you can stay solvent.
Hey, Itai, I want to just pause real quick. One of the questions that kind of came through when you were talking about where high yield debt was a question about yields. And what are you seeing in terms of the spread over the Treasury? And how's that trending?
Yeah, so basically the spread over the Treasury is not. I should have brought actually that chart, but the spread over Treasury is not significant. So probably around 2 to 3%, depending on what kind of bonds there is, which is similar to what it's been in the past comparatively. But remember, Treasuries too have gone down quite a bit. So a 10-year note is trading under 1% right now, or just about. So it's really, really low. Like, the safe asset return is essentially non-existent.
Got it. Okay, cool. Keep going.
So we covered this. Something quite interesting to note in this market is that for the first time in about a decade, companies are actually offering more shares than they are doing buybacks. So for the most of the recovery, and this is something a lot of corporations were blamed for doing, they're buying back their own shares, and in some years in pretty record amount. This year is the first one, going back all the way to 2009, that there's more share offering or more new share offering than there are stock buybacks. And that's fairly significant because stock buybacks have been blamed for propelling the stock market. And we can see that here. Yeah.
Oh, no, you keep going.
Okay. So you can see that here to the right, when you're looking at the different years. This is the first year now since 10 where there's actually an expanding issuance of stock. And that hasn't happened in quite some time.
But this graph is actually really interesting too on the right-hand side, because in 08, 09, they're raising capital to actually stay solvent, right? And now they're raising capital because the markets are just so vibrant that they're just looking at it as like a cash-in opportunity. Like, let's get liquidity because it's insane right now.
Yeah, that's actually quite unusual. Normally you see more issuance when companies need cash, like in 2003 at the bottom of the bear market, 08, basically 09, right when the recovery starts, they need money. It's fairly rare for more issuance to happen when the markets are high. And here it is to the left. This is the fundamental matrix of where the current valuations is. Here in blue is basically historically where it's sitting compared to the rest of history. And you see things like US market cap over GDP. This is what's so-called the Warren Buffett indicator. That's standing at 239% of GDP. Enterprise value to sales, EBITDA, forward P at 22.3. So this is, the 96th percentile, the highest since the dot-com period. All these very, very highly valued matrix, which, if you understand interest rates and you understand the discount rate, you kind of understand why these valuations are where they're at, given the interest rate environment. But nonetheless, there's no other place to put money. Money is just trying to find yield anywhere it can. Tina, there is no alternative. There is no alternative. Oh, okay. I thought that was the name of one of Rob's ex-girlfriends. Believe it or not, but Tina. Rob a hard time. Okay, I'm done. Tina is a viable investment strategy. And why wouldn't you issue more shares when central banks are pumping the largest amount of liquidity we've ever seen? December of 2019, we're talking about $16.5 trillion on the balance sheet, 25 trillion, and towards 2022, almost $30 trillion, 29% of GDP total is being propelled through the central banks. Itai, one quick question is, do you have any data about the corporate bond issuance versus their new stock issuance? Yeah, they've issued a ton of that as well. A ton of that. So it's just basically everybody's trying to get their cash from the market however they can. Yeah, I don't have the chart of that, right? But I had it about 2 calls ago. But as you can see in the, basically the high yield. So there was some kind of spike here due to COVID, but then the Fed announced that, we're going to buy junk ETF. We're going to buy high yield bonds. We even talked about it and showed you what ETFs they're buying directly and what bonds they're buying. And as a result, the market took that as a cue, as essentially the Fed has put a put option on high yield debt, and it's okay to buy the heck out of it. So that's essentially what happened.
Itai, is the stock market and the interest rate market still basically have the Fed put in place? And how long what would be the telltale sign that that's not going to be the case in the future?
Yeah, I believe 100% that they do. Otherwise, we wouldn't be able to explain a lot of these kind of moves we've seen. And we've also shown a direct correlation between the Fed balance sheet and the performance of the S&P 500. And we've shown it in pretty great detail. Again, I've asked that question before. And in August, in the central bank meeting that takes place in Jackson Hole, Wyoming, the Fed came out and said that they're going to. It was a very small announcement on the business news. I thought it had pretty big repercussions. They basically announced that they are abandoning the 2% inflation target, and they're going to pursue what's called a floating inflation target or something along those lines. Basically saying that they're willing to accept higher inflation for some time if it happens over that 2% mark. And I think that's pretty significant, because in order for this to stop, inflation has to go up. So they will raise interest rates or stop these QE programs. But now they're telling you, you know what, even if inflation does go up, that doesn't necessarily mean we're going to stop. And it has pretty profound implications.
Wouldn't you say though, if inflation, let's say, went to like 5 or 6%, that would just invariably have a magnetic effect on interest rates to pull them up?
That would be game over, given the amount of debt that's out there. That's the way I would see it. 5 or 6% CPI would be out of this world, you know, given the debt to GDP ratios. Okay, so we talked about that. So as the stock market has risen, household wealth reached new highs. So households have never been richer. You're talking about a net worth of about $130 trillion worth of wealth. And you can see how that has expanded dramatically since 2009. But that wealth was not shared equally, as now we're seeing the so-called K-shaped recovery from COVID, where it's been a total V recovery for some and almost no recovery for others. Here on the left, you see the employment for people with a bachelor degree or higher. Now for them, it's essentially as COVID didn't happen. They're exactly where they started in February, March. But those with high school or no high school have gotten decimated from COVID as a result. They're still not hired. Businesses are still closed. They have not recovered at all. Also, that recovery happens at the wage difference. People that are making over $28 an hour are actually better off now, slightly, by 5 to 6% better off now than they were in February. That is crazy. While we're having pretty significant permanent unemployment, and that's primarily hitting lower wage workers. So it's, even though households are now wealthier than ever, we've seen a completely uneven recovery, and that's accelerating pre-existing trends.
I mean, this makes total sense. We see, like, we hear the wealth gap widening. We see growing homelessness in a lot of these cities. Like, this, to me, is a pure reflection of that.
Right, and you see that in the data. And you know, I believe that low interest rate policies and quantitative easing is just exaggerating this trend, and I'll show you why I think that too. So you can see that the 10% financial assets basically owned by the 10% have grown steadily since the 90s into the 2000s. And now just about 88% of financial assets are owned by the top 10%. Here to the left, you can see that since the recovery started in 2009, the bottom 20% actually had a negative impact overall, where you know, the middle groups didn't really recover, and these groups have recovered quite a bit. So what do they have in common? They own financial assets. So the problem is, when you have low interest rates and you have this continuous increase in asset prices, if you don't own assets, you've just been left dramatically behind. And that's a part of the problem with these kind of policies. And just to bring that point all the way through, the top 1% own more than 50% of all stocks and mutual funds out there. So when the Fed is putting a put on the stock market, who do they really help? Do they help the mainstream economy? Not really, even though that's what they say they're doing.
Itai, do you want to take a pause here real quick, and let's just give everybody a chance to ask some questions? Everybody, we always, like I said, we try to make this interactive. I know we got a lot there. Are there any questions that any of you have so far?
If you broke that employment by education down by big states like Texas, Florida, Arizona versus like California, Illinois, New York, would you be able to pull that data? That would just be kind of interesting to see, or how much of a difference it would be.
I haven't dug into it on a state-by-state basis, but I can if you want to talk about it later.
State by state, no, we can hit that later.
Paul had a question earlier in the feed there, Jeremy.
Yeah, Paul, he also had to dip out, so he's not going to be here right now. So we will, I think we'll hit that later when we've got a little more time, because that's part for more of the open-ended portion of the call.
Right. Okay. So I'll just jump into that.
Go for it.
So Lastly, to just finish that point off, this is basically the wealth distribution over time. You see that tiny little red line at the bottom here? That's the bottom 50% of all households in the country. Wherein this is the 50 to 90%, top 1% right there. And essentially, this is the top 10% of households and the amount of financial assets they control versus everybody else. And more than 30% of households actually have negative net worth or no net worth at all. So the Fed needs to find a better policy tool to help more people. That's essentially the point. All right. The market now, even though we talked about it at the beginning, shorts have gotten pretty much screwed. A lot of people thought that it was pretty overvalued, but there are statistical measurements of overvaluation today in the equity markets I wanted to briefly touch about. Here to the right is a statistical measure of the market. Some people know this as Bollinger Bands. This is essentially an idea of 2 standard deviation from a mean, which is the normal distribution that you normally see. Now, not to say that markets can't exceed that and 1 standard deviation turns into a 2, etc. But over time, the market does have a tendency to revert around this mean, which is what it's done over the past 200 days, just as we know that growth doesn't happen exponentially most of the time. And we do have a trend that represents more or less a 7% per year rate of growth over a long period of time. So we can see here during the COVID episode, we have extended 2 standard deviation below and the market's recovered. But now we are seeing one of the biggest overextensions that we've ever seen in the Russell 2000, basically the small cap group. And here to the left, you see this is the distance that the price is from that 200-day moving average. And it's one of the bigger deviation to the upsides we've seen over the past 30 years.
Itai, do you still have any ideas to how much money is on the sidelines that corporates still hold? Because as I remember last time, it was quite a bit, and that could be a lurking wild card in all of this.
Yeah, it was a ton. It was over $16 trillion. I think that has pretty much gotten cut by at least 5 trillion as of last, but I need to double check those figures.
Okay, so there's even more dry powder that could.
There's definitely more dry powder, but a lot of it did get deployed into the markets as we warned that it may happen 6 months ago.
Cool.
So why have things kind of evolved? The market is an interesting thing where sentiment matters. Well, in normal times when the Fed doesn't buy everything, sentiment normally matters because if everybody is optimistic, everybody has already bought stocks, and then you're running out of marginal buyers to buy more stocks. And at some point, there's just no buyers left. It's hard to propel asset prices, and you need some kind of a healthy correction. So here's the sentiment measurement of people that, between permabulls, neutral people, economists, this is kind of measurement of people that are in the news and you hear of, and you see. So even the perma bears are no longer bearish, which I found to be kind of interesting. Because it's very hard to stay bearish in an environment where things go up consistently. And here to the right, you see an average of the put to call ratio in the orange line. And the other graph is the S&P 500. So it's interesting that when there's a lot of put activity, there's a lot of hedging, there's a lot of insurance buying. People normally buy those insurance options after something has already happened, right? So after a crash has happened, it's kind of like, think of it like you're purchasing fire insurance after your house just burned, but you're not buying the fire insurance when your house is totally fine. And what's interesting is as the market climbs up, people stop worrying about things. And normally when nobody owns puts is when the market peaks somewhat. When a lot of people own puts, the market stops declining. It's just interesting to note that very, very few people own puts right now, which potentially make this a good time to hedge and buy some.
Got it. Okay. And where could somebody learn, if somebody wanted to learn more about how to execute a put strategy, or maybe they're not, as advanced as you are, what resources could you point them to that could let them learn that?
I think we actually had a call. We talked a little bit about that, but
And I can distribute that if anybody wants that, just ping me. But are there any other sites or anything or books that you recommend?
Yeah, there's definitely a lot of option books. Let me try to think of anything that's really good for beginners. What do you think, Rob? Do you have any recommendations?
Macmillan on options is kind of the Bible there. It's like 1,000 pages. Get the fifth edition. And then the way it's broken up, if you want to just learn like one strategy, like if you're into seasonal spreads or calendars or something like that, you can go just to the chapter on that. And he gets into a little bit more advanced stuff. And it's a real good primer. That's one of the two kind of basics that you start with. And there's a lot, there's guys that write books. There was one that wrote a book about trading options on day of expiration. So you can go the full gamut of all kinds of crazy strategies that people do.
Cool. All right. You can continue your knowledge after us. It's in the chat.
Yeah, that sounds, I'm not sure that's a big beginner option book. Maybe something like Options for Dummies or something like that, if that exists. All right. So let's look into the quote unquote excuse the market needs to go down or to top out. And this is what Wall Street believes is are the biggest risks for 2021. And the first, almost 40% of respondents, these are actual fund managers that were interviewed. The virus mutates and dodges vaccines. Serious vaccine side effects start to emerge after that the vaccine comes in. People refuse to take the vaccines when normal return to life does not happen. This is an interesting one. The tech bubble bursts, causing a total fallout across the global markets. That's an interesting one. Central banks and government pull back the stimulus too early.
It's interesting how highly rated, how high up there the tech bubble bursting is. It really, really shows you
what they're thinking, right? Runaway money supply actually causes inflation. Back to Rob's point, which at this point, it's kind of funny that they've been printing money for 10 years, but inflation never happened. Inflation did happen, just not in CPI. It happened in asset prices. But anyway, a bunch of these, this is interesting. French election of 2022 comes probably because of a rise of the extreme right. Anyways, a bunch of these weird things, but what's interesting to note, I know this is a tough chart to see, so I'm just gonna brief you really quickly. This is basically prior years and what these same fund managers thought would be the risks for the next year. And what you could see is that in 2011 and 2012, it was the EU sovereign debt crisis, which has already happened in early 2011. So it clearly wasn't a problem. Then it was the US fiscal cliff, China hard landing, geopolitical crisis, China hard landing again after it already happened, political populism. That's when Brexit happened and Trump got elected. Quantitative tightening that the Fed was doing, trade wars with China, outcome of the US presidential election of 2020. That's interesting. That's kind of happening right now. And COVID. When did they start worrying about COVID? In May of 2020, which was actually the time to buy everything because the drop was already behind. So what is the lesson from this story is that none of these things that we've seen is probably what's going to cause the next crisis. Because what you need to worry about is the unknown unknown and not the known unknown. Because if you're thinking about it and it's known, it's probably not going to do anything because it's already priced in.
Can we just take a second and just appreciate the graphic that you have of the man about to go into this labyrinth? There's something pretty wonderful about that. He's just going into that world of unknown unknowns. Or actually, he may be leaving.
And he has your haircut, Jeremy.
Yes, my girlfriend's in the other room. She gives me the haircuts. So I'm going to have her send you an angry text message.
So that's kind of why I'm not super concerned about any of these things. It's quite rare for an event like this to, once it's passed, to come back and affect in any kind of way. It actually almost never happens. So that's about it. I'll stop if anybody has any questions.
And this can be questions about anything generally happening about markets right now. This is a totally safe place.
going into the end of the year and the new year, what kind of investment strategies are you going to talk about? Going as we go through first part of the year from here to like January 5th through the next meeting, I guess, which is the second Monday in January.
So when you're asking about investment, you're talking about like a speculative trading kind of thing?
Yeah. I mean, you said like, for example, valuations are high. There's not a lot of other stuff to put money into, but if somebody was looking at diversifying their portfolio here in the next 4 weeks, do they just sit on it?
Were you paid by Jeremy to pitch our idea that's coming next?
Of course he was.
Pray tell, we're all ears here. It's a Monday night. They're starting to shut down part of the United States again. So you got a captive audience, literally. Somebody's in jail, on a visa jail anyway.
I think we should do a special with Kevin Burke on investigative accounting.
You talk about like forensic accounting?
Forensic accounting. Yeah. Kevin, can we do a special?
I'm not sure that's my specialty, but I can make it happen. Is that what the people want?
I was happy.
I will tell you one night what we might do is crazy embezzlement stories. So not tonight, but like that'd be kind of like the after party. We do this.
I got like after party, crazy. That's your homework for the next call. Okay.
Oh no, I've got 4 of them. I've got 4 of them queued up. So I wrote, I think, about 1 or 2 of them in my book, but I've got 4 of them. So
beautiful.
I see a question in what's a driver for an emerging market rally? It's the drop in the US dollar. They're fairly inversely correlated.
Can you talk about how that relationship works?
Sure. They have a lot of debt in US dollars. And normally as the US dollar declines, it's easier for them to make their payments. Those companies. If you look over a long period of time, you would see an inverse correlation between the dollar index, DXY, and emerging markets.
Cool. Itai, we got some tech IPO questions. Mike, you wanna ask him?
Yeah. So when should I sell my Airbnb stock?
That's $1 trillion question.
Well, you want to give him some guidance or just leave him hanging?
And he looks like he's at an Airbnb right now. That's what makes it even crazier.
He first has to say this is not investment advice.
This is not an investment advice at all. See, the thing about it is that you never know when this craziness is gonna end, especially with stocks that don't have that much history of trading. It's the hardest.
What can you do to hedge a position?
Do they already have an open derivatives market or no? I don't think they do.
How long does it normally take to establish one after going public?
Yeah, I don't see any options trading yet. It depends.
So
it could be a few weeks.
What's the action item? Wait till you get to the derivatives market, then buy some puts?
Once you have an options market, it's much easier to gauge what the volatility level of the stock is going to look like and all that kind of stuff. Because the options market, they do a really good job at pricing the risk and volatility of an investment.
Got it. I see another question here. Christopher, can you expand on your question if you want to unmute if you're there?
Yeah, no, I was just making a comment. The commitment of traders on NQ regarding the tech stocks. No real question there.
Okay, got it. All right. False alarm on my end.
If anybody wants an expansion of that, the CFTC, once a week, they report the positioning in futures markets of anything from the index futures to commodities and things like that. And they report the positioning of commercial traders, large speculators, which are like hedge funds and stuff like that, and small traders.
Are you about the COT report?
Yes.
Yeah.
Itai, I had a question. I was reading an article from the CEO of MicroStrategy. That's the group that bought like 400 million in Bitcoin recently. And he said he was talking about how the money supply grew by 5.5% over the last decade, and this year grew by 20%. And
28%.
Okay, and then he was saying that raises the hurdle for corporate treasurers to preserve that purchasing power, and that the cost is now 20% to maintain that purchasing power. I didn't understand what that means exactly. Or how does that affect us, or is it just referring to people in the treasuries?
So can you repeat the question? I'm not sure I completely followed.
Yeah. So he basically says, I'm reading the article right now. It says, this creates a hurdle for corporate treasurers to preserve that purchasing power. The cost of capital of every cash treasury in the world is now 20%. So what is it saying they need to earn 20% to maintain their purchasing power? Or I don't really understand the statement they're making.
Yeah, I'm not sure I understand that wording either, to be honest.
Got it. I'll send you a quote of it, maybe be easier.
Okay. Yeah, let me read it.
I'm going to just post one last thing in here. I'm putting it in the chat right now. If you guys have any dream topic, any interesting topics you want us to cover, dream speakers for 2021, I want you guys to post it. You can send it for everybody to see, or you can ping me individually. And I'd say if that's it for now, I could get into presenting Equilibrium if you want.
We're ready.
We're ready for it? Okay, cool. Well, let me get this thing loaded first. I want to make sure I got it up. Okay, cool. So one second, I'm going to share my screen. You got to understand, I'm not used to being the one sharing my screen while we're doing this. It's usually everybody else. So I have to kind of figure out how to do two things at once. And now tell me, do you guys all see it? If you see it, do a double thumbs up. Okay, Kevin's not giving me double thumbs up. I see you texting there. Okay, cool. So basically, everybody, this is what we've been working on in the background for more or less the past year. We're really excited. It's Equilibrium. We're the family office for everyone. And I think a lot of this was really, came to be because of all of you being on these calls and getting to see how Itai looks at the world and realizing that, hey, you know what, there's a world outside of the public markets and there's probably some unique things that we could be doing there. So that, and one of our wonderful attendees kind of approached us and said, guys, you need to be dreaming bigger. And so that's really kind of what brought us into this. And so what we're trying to do on a high level is basically, we're trying to help individuals invest like the ultra wealthy. Okay, so we're planning on bringing in technology to help people get a diversified private market offering into their portfolios, right? So all of you can get your public market exposure as it exists today. You can go into Vanguard funds, you can go into ETFs, but one of the hard things is you might hear us on our calls and we're talking about, oh, we made a few $1 million in this multifamily deal. Oh, there's private credit. What about these hedged equities that Itai is talking about? What we kind of realized is that it is very difficult if this isn't your full-time job and if you don't necessarily have the time, the resources, whatever, to be able to do that it could be really unique if we came forward with a product to do that. So we basically want to give that offering, the one that we talk about on these calls, that somebody could access right from their phone, which I think could be really, really wild. And this has just kind of all happened organically, and a lot of this happened just by virtue of doing these calls. We haven't raised any money. We've gotten over $22 million that we manage. It's a very clear path to being over 25 in the next few months. Just on the invested capital, we've done 36% return, and our monthly AUM is growing at 27%. So a lot of things are kind of really happening. And we've just made a freaking killer team here, which is really cool. So you guys know me. I come from the world of startups. I built Spot Hero. I do a lot of the internal real estate for this venture that we're doing. And we're going to talk about that more. If you don't know what Itai is, you just heard him talk for a little bit more. He's smart. He's our portfolio manager. Itai, can you tell a little bit more about your background and why it is allowing this to be such a good fit for your skill set?
Yeah, I was fortunate enough to be in a place at UBS where I've seen a lot of super high net worth people and the kind of strategies that they were using to grow their net worth. And I realized the importance of alternative investing and Knowing options, for example, is just one of it. And, you know, how you're able to preserve wealth and things like that, using that. And then other strategies like private credit opportunities, which lending is a huge thing. Real estate is a huge thing, etc. And then after that, I launched a boutique wealth manager. I talked about it, also primarily focused on the high net worth individuals, and a quantitative hedge fund, which trading was definitely and still is a passion for me. And I just have exposure to a very wide variety of different strategies and different asset classes, and I kind of know how to bring them together.
Yeah, so this is very much falls in this category, and I'm really excited too because I get to introduce you to our third partner on this. So Tori, who's going to introduce himself in a second, he approached us with this big idea earlier in the year, and we started working together. You know, he saw us doing the calls. He understood that we thought about markets in a very contrarian way, and we're really lucky because Tori's background is that he's 2 times founded fintech companies, and he's had a lot of success in that world. And so, you know, by bringing him into all of this, we basically get to take the style of investing that we're doing and we get to productize it. So I really want to introduce you quickly to Tori, because I want him to share a little bit about himself, because you'll be seeing him more. And he's a nice guy and he's got good looking hair. So go from there.
That's one of the only times I've ever heard Jeremy compliment me on my hair. So I'll take it when I can get it.
Yes. I'm just jealous that I don't really grow it anymore. So it is what it is.
Both ends of the spectrum. It's like a barbell strategy for hair. So it's like Jeremy's covered for like all of those out there who want to relate to like, you know, the lack of hair end of the spectrum. And then I got you covered for those of you out there who have the flow. Like I'm looking at you, Joe Perla, if you're on this call still.
He's got killer hair. Anyways, Tori, tell us about you.
Yeah. So about me, I, you know, like Jeremy said, my background is more squarely on the, you know, the fintech, like the technology side. And, you know, I've been largely behind the scenes working with these guys this year on how do we take what is inherently something that is very challenging to scale and make it accessible to like a broader audience. Because for me and all the companies I've been involved with, for me, it really comes back to more of a mission orientation, which is like, at the end of the day, it's like, if you're ultra wealthy, you can find yourself an Equi, right? If you already have 50 million in assets, you can make it happen. Now, if you don't, you know, that's where that's a hard problem, which is like, how can we help you get there? And how can we help you get there faster? And so, you know, one thing that kind of unified us, yeah, and you can go to the next slide. What got the conversation started was when we were thinking really big picture here. You know, I was very aware because I'd been teaching separate from the calls here. You guys might not know this, but I've been doing financial literacy classes for about 8 years now. And in these boot camps, I've had hundreds and hundreds of people come through them, everything from Silicon Valley entrepreneurs to, you know, high level execs at Facebook. I do it for, you know, a broad range of the community. But the thing that's universally the case is I could see that the ultra wealthy, whether it's like endowment style investing or the family offices, like they get superior returns on their capital versus the average investors. So the folks who are just, you know, are vanguarding their portfolio or you're relying on Betterment or Wealthfront. And even if you went in just the S&P, you know, you'd still be underperforming these other styles of investing. And so when we dug into like the reasons why, it's very, very simple. Right? It's like at the end of the day, no, go up one more, just, yeah, leave it there for a second. So it comes down to like how much private market exposure you have in your portfolio, because individual investors have far less. And a big part of that is because they don't have access, or it's harder to evaluate those opportunities because they're not trained, they're not specialists. So now if you go to the next one, like the net result of that is that if you look at high level portfolio composition, individuals, which are on the far left, they tend to have like the vast majority of their assets in public equities, stocks and bonds, et cetera, and then very small amounts in the private markets. Professional investors have converged on what we believe is closer to an ideal portfolio, which is a 50-50 split between public and private. So now what's interesting is like anyone on this call can have as good a portfolio in the public markets as the wealthiest investors in the world, the endowments, the family offices. Like there's very little ways to compete and actually achieve alpha in the public markets. But where they really outperform is when you look at the private markets, they can really diversify across a broad range of asset classes and get access to funds and meet minimums to get into certain investments that the average person can't. If you look at like the market as it's composed today and apply the lens of like what solutions exist out there, some of you might have heard of like a company like Cadre or Equity Multiple or Yield Street. There's dozens of these platforms that have all, bubbled up, and they all look exactly the same. They're all kind of marketplaces, and they're where you go to get kind of like the scraps of deals. So they might list like a commercial real estate deal, or maybe you can buy a tiny chunk in an apartment building, and you're coming in at like a pretty disadvantageous place in the capital stack. But also the average length of the prospectus to like read about these investments is like 109 pages. And so I've invested on Yield Street, I've invested through Equity Multiple. Like I'm very familiar both as a customer and as an investor with these platforms. And the reason I was frustrated was because my portfolio today, right, is 50 public, 50 private, and it is composed that way, but I had to work really hard to actually make that happen. And it's like, I would prefer a managed solution, but if you look at like the only place where you can get a managed solution is if you're going to like the JP Morgans of the world with 50 million in assets or more, or if you have a family office, which typically is you have a couple $100 million under management, or a multifamily office, they're still having a minimum check size of 50 million just to get your foot in the door.
And
so
the real numbers, it's not even 50. I mean, when we talk to the people at Goldman Sachs, you're really only starting to crack into the good stuff when you're at 100 plus. And that's just, that's a really high bar, because it's not all of us are sitting around with an extra 100 million to spare.
Yeah. And so where we come in is kind of cracking this open for people who have far less assets. So initially we're going to start for people who are in the kind of $1 to $10 million range. But the idea is over time, we can make it available to even more people down market of that. So, initially we'll start with kind of the lower end of the accredited market and folks who have $1 million to 10 million in assets, who would never get access to like this caliber of investment management or these caliber of investments, but then eventually want to democratize it even further. So when we imagined like what the solution was going to look like, we were like, how can we bring both the kind of investing expertise like you get with someone, let's say with an Equi, but combine it with like a tech and a product ethos, so it's safe, easy to use, etc. That's kind of how we arrived at the product side of Equilibrium. The idea of we can understand your risk and liquidity needs, build you a customized portfolio across private real estate, private credit, hedge funds, CTAs and managed futures, so on and so on. And I'll let Itai kind of speak a little bit more towards this aspect here. But the idea is we can really personalize it for you. Itai, do you want to talk about that?
Right. So imagine people ask me all the time, so how do I get hedged S&P exposure? I don't know how to buy puts. I mean, I don't want to deal with it. I just want to own S&P but have insurance. Right here, you'll have a very easy option. Just choose how much hedged S&P exposure you want. Typically, we hedge it, with the best kind of managers, and we do it in such way that basically you have insurance for anything greater than a 15% drop in the market. So you can sleep much better knowing you have that kind of exposure. We know bonds are at 0. We know high yield bonds of the riskiest companies are barely at 3%. So you can have stuff like private credit, which is small business lending, other kinds of lending, inventory backed lending, all these things that banks can't do anymore because of regulatory reason after 08, 09. You can essentially have private credit bonds that we buy, bespoke bonds that are 2,000, 3,000 different loans, super diversified, liquidity within 9 to 12 months, and you get 8 to 9% on those. So that's income that you just can't get anywhere else. And we get the best managers to do it. Private real estate is something that we've been operating. We've owned now close to 400 apartments, and it's growing very, very quickly. So again, this is another major income component. I won't talk too much about hedge funds, as we all pretty much know what they are, but we pick really good managers, uncorrelated strategies. Same things with CTAs and managed futures. Really good managers that sometimes have hard time accessing capital, but they have a tremendous track record. So these are the kind of people that we're looking for. Volatility, crisis alpha, if you just wanted to just buy a hedge, and you'll have the ability to opt in and out of these asset classes.
And I would say, I know you just said a lot there, and we put it out there. Guys, you're all there listening. Are there any questions or things you want a little more clarity on? Because I'm sure you got some stuff.
Lockup period. How much?
Excellent question. Excellent question. So we basically ask you, what is your risk preference? How much risk you're willing to take? And then the second thing, what is your liquidity needs? So the idea would be if you need a lot of liquidity, you'll get more towards the CTAs, hedged S&P, volatility strategies, crypto-based lending, maybe some private credit, less hedge fund, less private real estate. If you don't care as much about liquidity, you'll steer towards other things. So it's just based on a sliding scale of your liquidity preferences. And essentially the way it would look like, you'll be told, for example, you come in, you'll be like, you have 15-20% of your portfolio available within the next 7 days. You have another 20% within the next 3 months. You have the full amount within, let's say, 1 year.
And you'll be able to view that like within the product itself. Like you can see here in the upper right where it shows liquidity, that'll give you a sense of exactly what's liquid and on what time frame. So we really want to innovate on the user experience as well, because like I hate being tied up in an investment for like 7 to 10 years and only being able to pick one or two. We want to make it much more of a blend because we're going to be aggregating funds and then ultimately aggregating managers. But to the manager, we are just a single check-in. So we're able to have a much more fluid relationship and get into funds that, you know, individual investors on the other side wouldn't really be able to get into.
Yeah, so there's a lot of funds out there. Some of the best hedge funds, for example, they only deal with what's so-called qualified purchaser. A qualified purchaser is a client that has more than $25 million in assets. So I don't have $25 million in assets, but if we aggregate a bunch of people together, we become a single entity to them. And then we can invest, you know, the $1, $2, $3 million minimum investment these specific hedge funds required. And on their end, we're just seen as a single investor. So we can do that. Then in the future, you know, if there's 10,000 users on the platform, the idea is you'll have a lot more liquidity because if you wanted to get out of a real estate deal, someone else wants to get in, and on your end, you won't notice it, but we'll be able to provide that liquidity. But that's something we're hoping to do down the line.
Yeah, and so something that's important to realize is that like a lot of what you guys haven't been seeing is like we've spent 3 months. A big part of when I was out in Austin with Jeremy and Itai working on this is we would spend hours and hours every single day on the phone with lawyers, because the irony is that like to architect this system, the biggest constraint that we're working around is our regulatory system here in the United States, which is pretty much designed to prevent individual investors from participating in the private markets. And we've actually, and the SEC is aware that this has created a huge problem and they're trying to like slowly over time fix it. But the issue is that like it's created a lot of misaligned incentives where all of the fund managers, all the best investments, they naturally are going to move up market and they want larger check sizes and fewer investments. And also Itai, it might be worth taking a second to mention like why RIAs, like typical wealth advisors, are also really misaligned. They don't really want people to take money, quote unquote, off platform, like away from their typical ETFs. And so all of this is kind of like working against the individual investor to kind of get them access to these type of investments, even though the returns and the effect on the total portfolio is very positive because you get more non-correlation, more diversification. But it's just net, we're having to kind of work a lot of magic, a lot of magic on the back end from a regulatory perspective to make it possible.
Cool. What other questions are going through your head?
How do you guys get paid?
Great question. Yeah, so we're approaching it from like the way we're structuring this in the back end. Remember I talked about kind of regulatory backflips we have to make. We're both the initial funds that we're bringing to market, it's restricted to accredited investors and it's hedge fund structures, because the only thing that will allow us to like invest across all this broad range of asset classes is if we have a hedge fund structure. An RIA can't do it. RIA, if your money is stuck on, Interactive Brokers or it's stuck on like Fidelity, they can't really invest off platform. And so that's why RIAs kind of have their hands tied. And so on the back end, it's structured, it's kind of a mixture of a fund of funds and, a lot of the real estate investing that you guys are very familiar with, that Jeremy and Itai have been crushing it with, that will also be kind of like a separate fund structure. So you can think about like the whole kind of robo family office, so to speak, as sitting on top of these private funds. So the only way to get into these private funds is through the app. And that's how we're kind of communicating and interfacing with the investors. And so then the fee model on the fund of funds is like a 1%, a typical like fund of funds model. And that's kind of how the business model works. Does that make sense?
And by the way, we've been able to negotiate with a lot of these managers that, you know, if you went to them privately and decided to build this portfolio, you would not pay more through us. So take an example, one manager that charges 2%, actually they charge 3% from individuals because of their strategy. And with us, they charge 2%, which we split with them 50-50. So if you go through what we're doing, you're actually paying less. And the reason is we're just able to write them a larger check and they need to deal with one investor. So it's a lot easier for them.
So I want to address David asked a really excellent question in the chat. And he said, initially, it's only open for accredited. What's the trigger to allow it for everybody else? Amazing question. And this gets at what we were touching on earlier, which is that it's kind of like the Tesla model, where initially we kind of have to offer a roadster that's really only accessible to, you know, that more middle to higher end of echelon of investors to accumulate enough, you know, capital and build up enough liquidity within the platform before we can act. And we have to build out our technology infrastructure as well before we can serve smaller check sizes. So the plan is within 1 to 2 years, we'll be able to launch a retail product that, you know, anyone, you know, we can have a much lower minimum, like a $5,000 or $10,000 minimum. But before we can get to that point, we probably need to get to the hundreds of millions or even approach about $1 billion under management. And then we're going to actually launch a publicly registered version of the product that will allow us to work with retail. There's a lot of nuance to it that I'm kind of glossing over, but that's the idea of how we move down market if we want to make it really accessible to everybody.
Awesome.
Yeah, we've been getting good questions about acquisition costs for users. And I guess part of it is we will see. We've been doing a lot of our work just right now is content marketing, which is just kind of required time. But what I think one of the unique things is in the hedge fund structure that we have, we actually do have the ability to run paid search ads against this. And so, you know, in my last company, Spot Hero, which was a very, you know, big consumer app, you basically have a bunch of different channels that you can run paid marketing against, and it should lead to different acquisition costs, lifetime values for customers. So as we prove that out even further, we'll have more data for you on that.
I think we should keep running through the deck real quick, and then
let's go.
So keep going down a bit further. We can skip past that. We kind of talked about that. It's worth actually scroll down one more. More.
This is kind of where it gets good.
Yeah, this is what you guys were all asking about, which is like initially we've had $1 million minimum checks, as many of you know who have reached out or asked about, you know, giving money to be managed by Equi, et cetera. So we've had a $1 million minimum, and we're dropping that now that we've reached around the $25 million mark. Once we register these funds, we're going to be able to drop the minimum to around 250K. At the 250K threshold, we plan to scale to around 50 million under management. Once we hit 50, we'll be able to drop it down even further to around a 25K minimum, and we'll be able to accept kind of 7,000 investors at that point. But we're taking a very kind of slow and steady approach where the first 100 investors on the platform, we want to build a very like bespoke experience, meaning like we're going to be interacting with them, building community, like making sure that they meet each other, but also give us very direct product feedback as we're building the product itself. And so we're at kind of a hard cap on that first 100 investors, because those are kind of like the VIP sort of founding customers, so to speak. And then once we've really vetted it out within that initial cohort, we're going to scale out to a broader audience. And that'll be kind of towards the second half of next year. Does that make sense?
Makes sense. So
growing assets, we can also open more asset classes.
Yeah, I should mention that our website is live. We saw it in the chat. Jeremy dropped a link in there. The invitation we're extending to all of you guys is we have about we've been getting applications almost every day actually since the website went live. The idea is we're going to be we're trying to be thoughtful about these first 100 investors and ensure that we can provide them a great experience, and that also we can get we want high signal feedback as we develop the product. So what the invitation that we want to extend, actually, Jeremy, do you want to maybe share a little bit about how we're thinking about this group specifically and
Yeah, definitely. I mean, like, I think what becomes really, really unique here is that, these are the people that, we're going to build the platform toward, right? So, the best deals that we're bringing through the pipe, the 150 unit building that I just got an LOI for today, that's going to be for the people that are on this platform. The other great deals that Equi is able to cook up, like, that's all going to be going to those first 100 people who are there. We're planning on building the tech, around their needs as well. So, people that like what we're doing, who've kind of, followed us in this mission and also have this pain point, we want to be able to build a tech product to work for you. We're imagining a world where you're able to see the performance of those private assets in real time, and that's no trivial thing. That's no trivial thing to build.
Oh, sorry.
No, what were you gonna say?
No, I was gonna say, and I also want to say that we're doing this in like a very kind of condensed, very forward format with everybody, because the plan is we don't want this to be kind of like these calls. We want to keep as focused on like the content as possible, and like keep this kind of in the back of the show, so to speak. But what's great is we're going to be able to invest a lot more in getting amazing guests, amazing content, really leveling up, because like we want to grow these conversations and ensure that we're bringing you guys just basically the best information you can get.
Yeah, we're still planning on doing this. This is just something that, if you've been with us, we've done 30 calls. We haven't even introduced anything like this yet. We're doing it because you guys are really the motivation behind it. And, you sign up, you get some hoodies and swag. And if you live in Texas, you don't even need a hoodie, okay? You get a t-shirt, you get a V-neck, whatever Rob Ross wants. Technical indicators of the 21st century, all right? I'm just giving you a hard time. But we're really looking for people that, have an interest in this. And, we feel really passionate about this. And this is kind of our life's mission. So we got to do it.